But now gold is dramatically undervalued relative to real interest rates. And I'm just talking about the 30-year yield less core CPI. That relationship suggests gold prices should be much higher than they are today.
You mentioned how we could see a downturn, a continued downturn in the stock market, maybe not a crash, but it seems like when we do see that, investors get into the mindset of sell everything in a sense. And sometimes precious metals do take a hit at those moments. So why do you think if the stock market does continue to fall that we will see a rally in precious metals?
Because I think out of all the market environments I've studied, this one reminds me the most of the early 2000s and the dot-com bust. And if you remember back to that time, that was around the time oil prices and gold prices were both, bottoming and forming, a major low before very strong multi-year bull markets. I think that's kind of what we're seeing again today. You're seeing a risk off, and gold corrected last year for a couple of reasons. One, it got too extended above where I consider fair value is for the gold price relative to real interest rates. And so that was kind of a sign that gold price needed to cool off. Sentiment got too big, too bullish at the same time. People, got too excited about gold in the early days of the pandemic. And so it was due for a correction. But now gold is dramatically undervalued relative to real interest rates. And I'm just talking about the 30-year yield less core CPI. That relationship suggests gold prices should be much higher than they are today. So that situation has fundamentally shifted. But also, I think we're in the process of, the last 2 years, we saw, like I said, animal spirits were super stoked to chase all kinds of different, risk. And so the idea of putting money in a safe haven like gold just lost its luster. People said, why do I need to put money in gold when I can buy Bitcoin, GameStop, the ARK Innovation ETF? I mean, all these things that are just screaming higher. But when you shift from a risk on environment to risk off, I think this idea of a safe haven starts to resonate with people a little bit more. And I do think we're going to see more of, and that's why I'm kind of a little bit more reluctant to call a crash in the stock market, because I do think we're more likely to see a shift out of, just like in 2000. If you look back into 2000, 2001, if you were a value investor back then, it was a wonderful time to be buying stocks. As the NASDAQ collapsed, 70, 80, 90% eventually, you had a lot of these super cheap stocks go up 50, 100%, in a period of time. The Russell 2000 at the time was maybe the best example of this. Those small cap stocks got real cheap and did really, really well through that period. I don't think the Russell today is as cheap as it was, but there are segments of the stock market I think investors are going to rotate into as they rotate out of these unattractive areas. And as I said, those attractive areas to rotate into are commodity related, precious metals related. And I think those, just because those stocks are so undervalued, I think people are going to realize, wait a second, I need to have at least 5% of my money in gold, probably more than that, miners and things as well. And when they do that transition, I think, is much more likely than to see a crash that affects the gold price and these types of things.
So when it comes to how gold and silver will react, it seems like you're saying that the Fed will probably end up being more dovish than the markets are expecting, and that is going to be bullish for gold. How would you say that investors should look into investing in gold? Because there's a lot of different vehicles out there for taking advantage of a rally.
It's a great question. My favorite way to own precious metals is through the Sprott Physical Gold and Silver closed-end fund. It used to be the Central Fund of Canada, but because it's a closed-end fund, it trades at a discount or a premium to its net asset value. Currently, it's been trading at, even though gold prices have been picking up and silver prices have been picking up in the last few weeks, it still trades at about a 4% discount to the gold and silver that the fund has in storage. So here's a way. If you want to buy gold, you can go buy it at 4% below, and silver, 4% below the market price. I don't know of anywhere else really to do that. CEF is the symbol of that. And if you own enough of it, you have to own a pretty big chunk. Sprott will convert your shares to bullion. So there is really no kind of paper gold risk in owning CEF that I see. So that's my favorite way of owning the metals. I do like the miners. I think, just something like GDX. I typically stay away from the juniors, but just because of the volatility and whatnot and the single security risk there. But GDX, I like the miners generally. I think that they are trading. Those stocks are really cheap. I mean, one I wrote about recently, Agnico Eagle, I think is the cheapest it's really ever been, at least in 10, 15 years, which is amazing to me because here you have probably the highest quality gold miner in the world buying, Kirkland Lake, which is one of the other highest quality miners on the planet. And it trades at 4 times, enterprise value to EBITDA, that's to me, market investors betting on lower gold prices. That's the only way you get that stock that cheap. Now, if gold prices do go back over 2,000 an ounce, which I think they will probably this year, that stock is, it typically trades 10 to 15 times enterprise value to EBITDA for the last 10 years. So at 4 or 5 times, it could literally, the stock price could double and still be on the cheap end of its range of the last decade. So I really like the miners, but I think it depends on, I like to have a core position in the metals and then use miners more as like trading positions.
I think that's so key. Is it seems definitely miners are a bit more speculative than if you hold the physical metal.
Yeah, and I just from an asset allocation perspective, owning the metal itself has benefits relative to owning, equities based types of vehicles, and so I like to own both. And like I said, I use the miners more as trading, because I do think they are higher beta, more volatile than the metals itself. But when the miners get as cheap relative to the metal as they are today, I'm definitely much more focused on the miners today than the metals itself.
And do you see any risk, I guess, in the miners if the price of production increases, for example, if oil prices, as we talked about, rise and different input costs rise? Do you see any risk there, or do you think that precious metals will rise enough to make up for that?
Well, that's a really good question because you could argue the oil price is still cheap relative to gold prices. I mean, gold prices are still very close to all-time highs relative to other commodities. You'll get a lot of other commodities indexes and they're not. I mean, the oil price is still way well off its all-time highs. And so, it is possible that oil prices rise more rapidly than gold if we see a generally commodities bull market. But the miners are so leveraged to the gold price that gold doesn't have to go up very much for their profits to continue to go higher. I mean, gold price goes up $100 an ounce, and it means major surge in the earnings in these companies. So, I don't think costs can really for costs to go up more dramatically than profits than revenues at these companies would mean, I think gold prices have to not resume their bull market. I just don't see that. I think if you're bullish on the metal, then the miners are really cheap relative to metals prices. So to me, that's the main thing to focus on.